This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 14 deals with transfer pricing, and much of this will be revision of material you should have covered in F5. First of all, we'll look at the aims of a transfer price, and really before that, why does it arise? And it arises really in cases of divisionalization, the overall organization being divided into two divisions, one perhaps manufacturing components, one assembling those components and selling it on. And we know that divisionalization can be very beneficial to organizations. It allows managers to concentrate on the operations that are being carried on by their particular part of the business. And so divisionalization is common, and once you have one division transferring to another division, automatically you have the problem, should there be a price involved? Should there be a transfer of value from one business division to the other? Should one sell to the other? The aims of a good transfer price are as follows. First of all, it's good if you can give all the divisions involved some profits. Profits are motivational. We all like to beat a profit target much more than we like to stay under a cost target. And if there were no transfer price at all, it would mean that the transferring division, the division making components, would never have any sources of revenue. It would be condemned to making losses. So good transfer prices will divide up the profits, giving a bit of profit to each of the divisions and therefore being motivating. Secondly, autonomy. What you don't want in a divisionalized situation is say to a manager, well, you are in charge of this division, and then you keep coming back, head office keeps coming back and interferes with what that manager is doing. The manager feels very disillusioned and so on. What you want to do is to set a transfer price and then go away and hope that the managers make the right decisions. And they make the right decisions if they achieve goal congruence. Goal congruence means that when a manager makes a decision about their division, and that will probably be a decision to maximize the profit made in their division, it also is a decision which maximizes the profit made by the group. So managers making a decision what's good for the division is good for the group. You need transfer prices for accountability. If you didn't have transfer prices, it could be difficult to know where the costs actually lie, who is responsible for certain costs and certain events. And the second reason is performance measurement. If the division which received goods in effectively received those free of any sort of charge, it's going to make massive profits. And it's going to look very good. Whereas a division transferring out these goods free of charge is going to be, as I say, condemned to making losses. A good transfer price, perhaps one based on market prices, would allow us to compare the divisions to companies that are standing on their own, that are not part of a group or divisional network. So if you have to transfer goods out at a market price, then it's as though you're standing on your own feet. And if you can't make a profit doing that, then maybe that division should be wound up. Example 1. And all of these examples are taken from your notes. So here we have Division A produces goods, transfers them to Division B, which packs them and sells them on to the public. Division A has its own costs of 10. Division B has its own costs of 4. And they sell to the public at 20. There is no mention yet of what a transfer price might be. I will just kind of play around with various little scenarios just to get used to the shape of it. So, we can set it out as A and B, and we will have transfer in costs. Which is nothing for A, because it's first in line. And then we have own costs. Other own costs are, it says 10 in Division A, and 4 in division B. So the total cost there will be 10. And then we can have some profit. And then we have a transfer out cost, or transfer out price, or a final selling price. We know there the final selling price is going to be 20. That's really all we can fill in at the moment. We don't know what the A transfers to B at. We can put in some figures in a moment to see what that's going to be. But what this allows us to do is to decide what the group profit per unit would be. And the group profit per unit is obtained by saying, well, the real outside costs, the own costs which we got in here, is 14. The real outside revenue is 20. So the group profit that we're dealing with is 6. And all that varying the transfer price is going to do is to alter who gets this part of the 6. How much of it does A get, how much of it does B get. So if we put a transfer price in here, for example, of 12, then the profit here will be 2. So my finger keeps going for that. The profit here will be 2. And this is then transferred up there at 12. We have transfer in costs plus own costs giving us 16. And we have the 4 there. And both parties will be willing to operate at that transfer price. If you're going to transfer goods at all, both parties must be willing to play ball. So A is willing to play at a transfer price of 12 because it gives it the opportunity of making 2 per unit. B is willing to operate as well because it gives it a profit per unit of 4. They both get profits, so that's okay. If we had set a transfer price of, let's say, 17, so it would be coming down in here. A would be in here at, same as before, 10, 10, and then we're going to put in here a price of 7, 17. A makes a really nice big profit of 7, but when you get up to here, these poor people are transferring in at 17. They're their own costs of 4. They're going to have 21, and they're going to be making a loss in there. So that transfer price would simply not be operative, although A would dearly love to sell at 17. B will not want to buy at 17 because that condemns it to making a negative contribution of 1 per unit. And one of the things we need to keep looking at when we're looking at our transfer prices or ranges of transfer prices is transfer will only occur if both parties at least avoid a loss. On the very margin, they might put up with making 0, but they will not volunteer to buy or sell goods if doing that will make them a negative contribution. Okay, let's see the next example. Asks us here to calculate the transfer price, the profit made by the company overall, and the profit reported by each division separately. It's very, very simple. So it is. So it's really just setting it here at costs plus 20% as one of the ways of setting a transfer price. But the shape is the same as before. A is transferring to B. You have the transfer price. We have own costs. That'll give us total costs. We're going to have then the transfer price out, or the selling price, depending where it's going. So A has no transfer in price. A again is first in the chain. It has costs of 15 per unit. So its total costs per unit are 15. It transfers the goods to division B, which is additional costs of 5 per unit, so its own costs will be 5. And division B can sell externally at 30, so that's going out to the public. The company has a policy of setting transfer prices at cost plus 20%, plus a third. So the cost plus 20% in here will give us 3 there, will give us 18. So this is going to put 18 up here. 18 and 5 is going to be 23. This is going to be 7. So all we've done is really put a slightly arbitrary rule in here. This is be called a cost plus approach to transfer pricing there. It is going to give A some opportunity of profit. Also here gives B some profit. It should work. They might argue over the relative sizes of the profits. A might be complaining that it's only getting 3 per unit profit, whereas B is getting 7 per unit profit, and so on. But that's really kind of fine negotiations, really, but it's going to work. Overall, it says here that the whole group is going to get 10. 3 profit in A, 7 profit in B, 10 overall. And we can make sure that that is right, because the final selling price is 30. A's own costs were 15. B's own costs were 5. So that indeed is 10. And all we've done is to split the 10 into 3 and 7. So it would work. It would be a viable transfer price. It's not too bad. It's giving both of the parties some profit. What are the practical approaches to transfer pricing? And we'll come across later, or very soon really, some theoretical objections to some of these. But the practical approaches which are used by people are, first of all, cost plus. That's like the last example. Cost plus 20%, cost plus 25% is a way of getting to a transfer price which should give you some profits. The plus 20 or plus 25% can be a little bit arbitrary. And a very strong contender in a practical transfer price is a market price. You see, people might complain, why have you done cost plus 20% and not cost plus 25%? And B, buying in, says, why am I being charged at cost plus 25%? If you say, well, I'm going to transfer at transfer prices, neither party can complain quite as much. You can say to the division A, if you like, well, I'm getting you to sell at market price as though you're on your own. Let's see if you can make a profit of that. And you can say to division B, I'm getting you to buy at market price as though you were standing on your own. And let's see how you deal with that, rather than being kind of feather-bedded by having artificially set transfer prices which can distort performance. Marginal cost, you transfer at marginal cost. The difficulty with this is that it would give the equivalent division A, the transferring division, no profits, and indeed it condemns it to making a loss. Transferring at marginal cost will cover marginal costs, but you're left with a big debit on the fixed costs, so it's maybe not very motivating. Marginal cost plus lump sum. What happens there is during most of the year you transfer at marginal cost, and we see this can be quite a good approach for goal congruence, because it allows division B to see what the true marginal cost to the group is. And then at the end of the year you say, right, let's make a journal transfer. Let's give the transferring division some more income, if you like, to cover profit. That's the lump sum. So as goods are being transferred on a daily basis, it's done on marginal cost. Then at the end of the period, there's a big transfer from the buying in division to the selling division, the first division, to give the first division the opportunity of some profit. Dual prices are very eccentric. We're not talking here about financial statements, but what it means is you can let division A sell at one price, let's say at 20 per unit, and this would give it the chance of some profits. But division B, for its management accounting, buys in maybe at 12, so that and 12 might be the marginal cost. It's obviously going to give a problem at year end when you try to reconcile current accounts. And we're not talking about financial statements. We're talking about bookkeeping during the year. A sells at 20, is incentivized to make and sell at 20. Perhaps at 20 it makes a profit. B buys in at 12, and because it's buying in at a relatively low price, it's incentivized also to take those goods, buy those goods, spend some more money on them, and to sell them on at a profit. And then at the end of the year, we argue over it. And then negotiated or imposed transfer prices. Very often, head office has a function in imposing transfer pricing. It's kind of sitting at the apex, if you like, looking at its various divisions, deciding how it wants those two divisions to actually behave, and imposes a transfer price in the hope of getting those divisions to behave in a way which maximizes group profits. Okay, let's now look at examples 3 and 4. So it's set up pretty much as before. We have two divisions, A and B, and we'll just set up the kind of cost structure so far as we know them. And then we'll gradually develop a kind of rule for transfer prices that will actually work. So we'll start over here. So we have A transferring to B. And we have the transfer price or the transfer cost, nothing in A. We have the own costs in A and B. So here it says division A has costs of 20. Transfers the goods to division B, which has additional costs of 8 per unit. And division B can sell externally at 30. So here we have total cost of 20. There's going to be a little bit of profit in here. And the profit that we have, it says it's going to be transfer price at cost plus 20%, cost plus a fifth. So we're going to be setting it out at 24. So that is the transfer price that's going to go through to B. So this comes up to here. In goes 24. We have got 32. The outside selling price is 30. So that's outside. And this means, unfortunately, that B is going to be making a loss of 2 per unit. Excuse me. And B, if you were the manager of B, you would say, no, I won't deal with these products. I will not buy anything from A. Why would I buy something from A if it was condemning me to making a loss of 2 per unit? So transfers will simply not work here. But we want transfers to work because the total of own costs in here is 28. The external cost is 30, so the group can make a profit of 2, but you have to get both players to cooperate within that. So what transfer prices would actually work to make the transfer, what limits, what range of transfer prices would work to make both parties willing to participate in the transfer of goods? So let's think first of all about the person in charge of division A. Every unit that is processed through division A, there's a marginal cost there, an extra cost caused of 20. And division A will not want to make and sell goods if it gets less than 20. Okay, so the minimum transfer price is going to be 20, In other words, equals the marginal cost. At 20, A would make nothing, but at least it's not making a loss. And A, the transferring division, is the one which is going to determine the minimum transfer price that's going to operate. So that's the minimum. Let's look at division B. So what we have in division B sees some, well, two ways of doing it. Let's say on the cost side we have the transfer in price, plus we have own cost of 8. So that's every unit that B processes, buys in and processes, costed the transfer price plus 8. And for that, B can get 30 maximum from the outside customers. This can be turned round and we can have the transfer price is equal to 30 minus 8 equals 22. And that 22 is an important figure in transfer price work. This is called the net marginal revenue. The marginal revenue you earn after your own transfer in prices. And this determines the maximum transfer price. If the transfer price was 23, then B would be buying at 23, doing 8 of its own work, bringing it up to 31, only being able to sell at 30. So the maximum transfer price is set by the receiving division, if you like. The minimum transfer price is set by the supplying division. So we've got in here a range of transfer prices that would operate. Successful transfer price, the range of transfer price is going to be 20 minimum to 22 maximum. Anything in there would work. I suppose you could argue maybe the fairest transfer price is to set it at 21, allowing each of the parties to get a slice of profit of 1 per unit. Example 5. And now we begin to try to work towards a rule for the permissible range of transfer prices which will actually work. So let's set up this little example, this little structure here. So we've got A and B. We're going to have the transfer in cost. It'll not be anything for A, it'll be something for B. We have our own costs, 15 for A and 10 for B. A little bit of profit, and then we will have the transfer price. Down here we have the final selling price. B sells externally at 35 per unit. Difference in here is that as well as A being able to sell to B at whatever the transfer price is, A can also sell part finished goods externally at 20. So it's also got a bit of a selling price in there of 20. It's important to see that A has unlimited production, but that there is limited demand externally from A. So let's say that we set the transfer price at 18, just for the sake of argument. What would you, as a manager of A, do? You are making goods for 15, and you can see I can either sell them within the group at 18, the transfer price, or I can sell them outside at 20, and of course you would prefer to sell them outside at 20. Now what you would do is you would keep selling outside at 20 until this limited demand had been satisfied. And then you would turn your attention to selling up through to B. Okay? So that would work. I mean, that would work okay. We could have a transfer price in here of 18. That will give this a profit of 3. we're selling up in here, eventually selling up in here at 18. We have got 28 in there. That's going to give us 7 there. That's going to give us 10 profit. And we know it's going to give us 10 profit. We know that is correct because the total cost we've got there is 25. Their true own costs are 25. The true outside revenue is 35. So again, there's a 10. So all we've done in here is really to split the 10 profit that's available for the group to 3 and 7. So here we could say that the minimum transfer price, that's going to be determined by A. The transferring division always sets the minimum price. That's going to be equal to the marginal cost is equal to 15. If the transfer price were lower than 15, after we exhaust all the sales to outside at 20, then we'd stop, because there's no point making more units at 15 only to sell them at 14. The maximum transfer price, that's going to be set by B. The buy-in division, that's going to be the net marginal revenue. So we've got 35 is the revenue coming in from outside. We have own costs of 10, going to be 25. So if, for example, the transfer price was set at 24, then we'd have 24 plus 10. It's a big one. If the transfer price was set at 24, we have 24 plus 10, that's 34. We're selling at 35, that still gives us 1 profit. But if the transfer price was 26, we transfer in at 26, not this 18. 10 and 26 is going to give us 36. We're going to be 36 costs, 35 revenue. We're not going to deal. So the minimum and maximum transfer price is 15 up to 25. And nothing much has changed in that example from what we saw before. Let's look at example 6. No figures have changed, but what has changed is now we have limited production capacity in A and unlimited demand. So, division A, division B, we have the transfer price, that's going to be nothing there. We have our own costs, the same as before. That's going to be 15 and 10. We have the kind of total costs there, got a bit of a profit there. We can have the transfer price there, or again we can have a selling price going on here. Can sell externally at 20, and the external one here is going to be 35. Let's say that we set the transfer price at 18 again. So here you are the manager of A. You see I'm making something for 15. I can either sell that to outside at 20, this outside selling price, or I can sell it up through the group at 18. You would choose to sell it outside at 20. The difference with this example is that you could sell all of your production outside at 20, because your production is limited, outside demand is unlimited. In the previous example, our production was unlimited, outside demand was limited. So we could do everything we wanted to in the previous example. In this example, because our production is limited, we can't do everything we might want to do. We'll do what's best. And with a transfer price at 20, transfer price at 18, nothing would ever go up through B. Do we want it to go through B at all? Does it matter? Because of course, if we transfer outside, we're making the group a little contribution here of 5. So that's worthwhile. But we know that if we were to transfer up through the group, we're actually making a profit of 10. So the group definitely would prefer actually goods to go up through the group rather than kind of escaping from the group by A selling those. So what we want to do is to set a transfer price, the minimum transfer price. This is going to be determined by A. It certainly has to be at least 15, because if it was less than 15, A wouldn't make anything because its own costs are 15. But the behavior we want to push A into is to volunteer to sell up through the group. So the other one is 20. A transfer price of 21 will get it to sell up through the group. So really what we need to do is to say it's going to be the greater of these two. The transfer price has to be at least 15 to work at all, for A to make at all, but then for B selling up through the group to compete successfully with selling outside, we have to provide it really with a competing price of 20. Now normally, in fact, it's not actually explained quite like that or defined quite like that. It's usually defined as a minimum transfer price. It's a greater of the marginal cost, and really this 20, it's really the marginal cost plus the lost contribution from selling outside the group. So rather than saying greater of 15 and 20, we say it's really the greater of, or we really say it's the marginal cost plus the lost contribution we were getting from selling outside the group. So it's going to be 15, that's the marginal cost, and the contribution that A would get from selling outside the group is 5. It's going to be 20. So we have to make A as well off as it would have been had it been selling outside, which effectively comes to offering it this competing price. Example 7. This is where B has a bit of a choice now as to what to do. So we'll set it out as before. So A, B, with the transfer price, nothing there. We have our own costs in here. So division A has changed slightly, these figures. Has got 8 per unit. B has got additional costs of 4 per unit. They're each going to make a little bit of profit. So we have the total costs in here, that's going to be 8. We don't know what that is. A little bit of a profit. And a transfer price going out. And here we're told that B can sell externally at 20. However, B could, instead of buying from A, B can buy inside now. It says here that if division B can buy part finished goods externally for either 14 or 18. So let's look at the 14 to start with. And again, you have to get at it and thinking, what would we want the group to do? Okay. The group, in order to get a unit within B, can either pay 14 to an outside supplier or essentially pay 8 if it gets A to make those goods. Okay. Therefore, we could say that so far as B is concerned, I don't think there's any problem with A here. So with A, the minimum transfer price is definitely going to be 8. A will not suffer a negative contribution, but if we look at B here, it's the one that's going to determine the maximum transfer price that we want to give to B here. And what we don't want to do is to make B prefer to buy in outside at 14. Because that's a 14 cost to the group. Whereas if something is made by A and passed up through to B, then the cost to the group is no more than 8. Okay? So we're looking here at 14. The maximum transfer price is going to be 14 in that situation. If the transfer price was 15, if we put in here 7.15, we're faced here either with a decision we buy in from there at 15, or we buy in here at 14. And all that happens is if you buy in there at 14, you have your own costs of 4. That's going to be 18. We sell outside, we're only going to make a profit of 2. Whereas we know the other way, 8 plus 4, 12, we can make a profit of 8. It is better for B to buy internally, better for the group if B buys from A internally. 8 is a lower cost to the group than 14. What happens if the buy-in price, instead of being 14, were 18? Now, what we need to look out for here is the net marginal revenue of B. Net marginal revenue of B is going to be 20 minus 4 is going to be 16. Okay? Net marginal revenue is going to be 16. So every unit that B makes, it can get 20 revenue from outside. It has to account for 4 of its own costs. The net marginal revenue is a 16. And if the net marginal revenue were 16, then 18 becomes a big irrelevance. No one is going to buy in at 18 if the best you can do for that is to net 16. Okay? So really, we come down here that the net marginal revenue is going to be relevant for the transfer price. There's no point in putting transfer price of 17 in there. Okay? The maximum transfer price that would get goods going across is if this were set at 16. So this will be 16. Plus 4, this will be 20. We're just breaking even there. So the rule here is that a transfer price has to be the lower of the buy-in price of 14 or the net marginal revenue of 16. Okay? It has to be the lower of it, because if the transfer, the buy-in price was 14, we would prefer to transfer up through the group. So we have to offer B a transfer price low enough in a way to beat the buy-in. So it is the lower of the outside buy-in price and the net marginal revenue. So here are the rules. The minimum transfer price is determined by the transferor or seller. It's the marginal cost plus the lost contribution you would get from internal transfer rather than external transfer. The maximum transfer price, determined by the transferor or the buyer of the two, is the lower of the net marginal revenue and the external buy-in price. But don't worry too much about the rules. Understand the logic and the reasoning that's going behind it. What you should be determining in all transfer pricing questions is what is best for the group, and then you have to offer both the buyer and the seller transfer prices which makes them volunteer to do what you want. For international aspects, some other elements come into thinking about your transfer prices. There is taxation. The idea would be if you are in a low taxation area, then you want to transfer to another division in a high taxation area. You put a high transfer price on that. You may as well earn the high profits where the tax is low, burden the second division with a high transfer in price, it'll make small profits. That's where the taxation is high. So taxation can be important, though you can be sure that the revenue services in countries are aware of people manipulating transfer prices to avoid corporation tax. There's a lot of controversy about that anyway at the moment in companies like Amazon and Google and indeed Apple, who seem to arrange to have a lot of their profits ending up, certainly within Europe, a lot of their profits ending up in a country like Ireland, which has got a very low corporation tax rate. Second one is remittance of profits. Some countries, if you make a profit in that country, are reluctant for dividends to be paid outside that country to the holding company. So if you're transferring goods into one of those countries, you transfer them at a fairly high price, so that not many profits are made within that country. Quotas and tariffs. Sometimes governments will act to try to reduce imports to maybe favour their own products, and quotas and tariffs. A tariff is a special tax on imports collected by the government. This is likely to distort the free movement of goods. We just have to have an eye on what's possible. Exchange rate considerations. The exchange rates move. We can expose ourselves to some risk in these situations and so on. If we're transferring goods, let's say from Europe to America, the goods there will be in dollars. If the dollar weakens, the price goes up and so on. And it may not be competitive to keep the same transfer prices in the face of currency movements. And finally, we have to have an eye on the competition. It's all very well saying, oh, I want to transfer at this price and so on. But we've seen from these examples where we can sell externally or buy externally and so on. We just have to watch what the competition is up to and make sure we don't set transfer prices which favour the competitors at the cost of group profit. So here are 3 suitable questions for you to try on transfer pricing.